Today, we've got a great Rocket Blocks case featuring two of our experts, Ben Wilson and Ashwin Shetty. The case revolves around a large US-based dental practice that is considering adding a captive financing arm to their business. If you don't know what captive financing means, don't worry about it. It will be covered in the case. The interviewer is Ben Wilson. He is a former consultant from EY Parthenon and currently a consultant at Alvarez & Marsal and a graduate of UVA's Darden School of Business. The candidate is Ashwin Shetty. He is a former manager from Bain and Company and holds an MBA from the INSEAD School of Business. So let's go ahead and jump in.
Hi, Ashwin. I'm Ben Wilson. I'm a director at Alvarez & Marsal, and I'm going to be playing the role of interviewer today.
Thank you, Ben. I'm Ashwin, a former Deloitte director and a Bain manager, and I'll be playing the role of a candidate here.
Ashwin, we have a really exciting case today. Certainly very long, a lot of information to get through, so we're going to jump right in.
Sure, Ben.
Your client is a large dental practice management company operating 800 dental offices and employing more than 2,500 dentists across the eastern United States. These dentists perform a range of preventative and treatment services, one of which is fitting and forming dentures. Dentures are complex prosthetics costing about $2,500 on average for a complete upper and lower arches, and as a result, patients often finance them. The client does not directly underwrite any loans, though, but partners with a number of third parties to offer these loans to patients in the office. Your client's private equity sponsor is curious whether creating a captive financing arm for dentures, an in-house loan underwriting service, represents an attractive new cash flow stream for the business. They've hired you and your team to investigate and make a recommendation.
Thank you. Thanks a lot, Ben. Let me recap the key information elements that you have shared with me so that I've got my understanding right. So the client is a dental company. They have around 800 offices, 2,500 dentists. What you told me is dentures is a complex dental treatment that costs around $2,500, and patients often seek financing for this denture treatment. The client currently partners with a number of financing companies who finance patient loans. However, the client private equity sponsors is interested in setting up a captive financing arm, and he's asked us to investigate whether it offers an attractive cash flow stream. Have I got the case facts right, Ben?
That is excellent.
Great. So what I would like to do is that I have two clarifying questions to ask, and post that I'll take a minute to formulate my initial approach. Does that sound okay with you?
Perfect.
Great. So the first clarifying question that I wanted to ask is it okay to assume that the client's primary goal is to maximize profit?
Correct. Yes, that should be the running assumption currently.
Thanks for that. The second clarifying question that I wanted to ask is that do they intend to replace the existing financing partners that they have, or do they want to support patient segments that are not being currently financed by our existing financing partners?
Yeah, that's a great question. I'd say it's most likely the latter, but certainly if we can find a more profitable option for the prior as well, certainly open to that.
Thank you. Thanks a lot, Ben. Can I then take a minute to formulate my structure?
Please do.
Thank you. I would like to share a suitable structure with you and would love your feedback once I've shared my framework, right? The core question that the client is asking us is, does opening a captive financing arm offer an attractive cash flow stream? Now, what I would recommend is that the client should open a captive financing arm if three conditions are met. First, it must make financial sense, as the client's main goal is profit maximization. Will the decision generate enough additional profit to recover the investment cost of setting up the financing arm in a short payback period? Now, that's the core decision criteria that we will need to test. Second, I think the client will need to check whether they can acquire the necessary capabilities, including operational capability to underwrite loans, financial capital to fund the loans. Third, the client must be prepared to handle associated risks. I have a few risks noted down, which are very important for the client to assess. One of them is credit risk, second being regulatory concerns or regulatory risk, reputational risk, and finally, conflict of interest risk, specifically with their existing financing partners. Now, if these three conditions are met, right, the client should go ahead, or we would recommend the client should go ahead. But the key among these conditions, I think, is the financial viability. Because if it doesn't make financial sense for the client to set up this captive financing arm, we don't need to really investigate the capabilities and the risks here. Now, from the financial aspect, we would like to analyze, or we need to check how much additional profit the client can make. And from an additional profit perspective, I would like to disaggregate it into revenue and cost components. And I think there are two key revenue components to consider here. One is revenue from additional dentures the client can sell. The second is revenue from interest fee client can earn through financing. From a cost perspective, I think there are three key costs to consider here. The first is cost associated with additional dentures that the client can sell, potential losses from loan defaults, and finally, the additional operating cost of providing the loan service. Now that I've outlined my structure, unless you indicate otherwise, then I would like to prioritize the financial assessment because, as I said earlier, financial viability is the key condition to check over here.
Excellent. I think that's a fantastic way to start. And I think a lot of those points we probably will be able to touch on during the purpose of the case. Initially, I'd like to share something with you. And before I perhaps put it up on screen, going down that same road of the financial piece that you just referenced, the basis for the private equity owner's question is in the chart that I'm going to put up as we speak. Please let me know when that is up on screen.
Sure, I can see the chart on the screen. Thanks for sharing it. Can I take a minute
Excellent.
to observe the chart and present my insights to you?
Please do.
Sure. So Ben, I can present my thoughts to you. What I see from the exhibit is the client's offices are in areas with more subprime and deep subprime patients in the average US area, right? And that's the insight I get from the client markets graph compared with the average US area graph, right? The second insight that I gather is that the client's denture patients are less likely to be subprime and deep subprime than the local population. Now, this could be attributed to subprime patients not requiring dentures, but that seems unlikely. But a more likely scenario, I think, is a lack of financing, right? And a lack of financing is causing subprime patients to not opt for denture procedures. Now, if that is the case, client has an opportunity to increase their revenues by offering financing to this patient segment, right? So that's my key insight, right? I think if client were to set up a captive financing arm and offer financing to subprime and deep subprime patients, I think the number of patients will increase. And because of the increased number of patients, you would see increase in revenue as well as profits.
Excellent, Ashwin. I fully agree with your insights, and I think that is a fantastic approach. I'm going to go ahead and take down the sharing. Give me just one moment. And as part of that analysis, I think again, you make a fantastic point. So on your case, the partner has seen this pattern before, actually, in the auto finance world, and brought to your hypothesis that the client is actually losing out on medical billing revenues to subprime and deep prime denture patients. They could be captured if the client offered riskier financing options. The client's typical dentist office sees 300 denture patients per year. Can you give me a size of the lost revenue opportunity?
Great, thanks. Thanks for that question, Ben. The question that you're asking me is, what is the size of the lost revenue opportunity or the incremental revenue opportunity that the client can capture? You've told me that the client's dental clinic see 300 patients a year. And from the earlier chart that we received, we know that 6% of the client's patients are subprime and deep subprime, right? And if each office has 300 patients, that translates to 18 subprime and deep subprime. So I'm just making an assumption that it's 6%. It seems to be around 5 to 6% from the chart that you showed me earlier. Now, if I exclude the subprime and deep subprime patients, we remain with 282 prime patients per office. When I say prime patients, I mean the three categories, which was, I think, prime, near prime, and super prime. Now, the proportion of subprime and prime will mimic the client market if the client were to start offering financing to subprime patients, right? So the proportion of subprime and prime will be 30%, 70%. So that's how the proportion will change from the current 6% to 94%. And we know that the prime patients are 282. So that will be 70% in the new setup once the client starts offering financing. So if 282 patients are 70%, that translates to a total number of patients to 400 per office, right? I'm just rounding 282 to 280 to get to 400 per office. So that's 100 more than the current total of 300 patients. And we also know that each denture costs $2,500, right? 2.5K. So with 100 new patients, each office will earn 250K additionally. And considering 800 offices, that's a potential of 800 into 250, which is around 800 into 250. If I do this quickly, that's around $200 million in additional company revenue. Is that a good analysis, or do you think the answer is not accurate here, Ben?
No, I think it is. And I appreciate kind of the assumptions that you made building into it. So understanding this, certainly impressed by the magnitude of the revenue growth opportunity. But it'd be great to also understand whether this is a profitable business on the back end. So your partner just ran into the VP of Finance in the hall. He actually has a question on the data you need to run the math on the project's contribution margin. So I'm going to give you a few other stats, and perhaps we can work that into this analysis. So each set of dentures costs $2,000 to produce, inclusive of dentist time and lab manufacturing. So you can consider that kind of an all-inclusive number. A typical loan is paid down in a straight line over 36 months and is billed interest at 20% per year and has a 30% charge-off rate for uncollectible balances. So for simplicity, you can assume that 30% of the value is the principal and the lifetime interest of the loan portfolio, and it can't be collected and is not paid back. Additionally, the typical amount financed is 100% of the cost. So, given this additional information, as well as, what you know thus far, the partner would love to see the size the expected profit opportunity could be.
Great. So I would need some time to analyze, Ben, but before I take time for analysis, let me recap some of the information that you've shared with me, right? What you've shared with me is the cost of denture is around $2,000, right? A typical loan value, right, that we offer to subprime patient will be, I think, 2.5K, because that's the price for each denture. Now, this loan tenure is 36 months. The interest rate of the loan, annual interest rate, is 20%. And you've also shared that the loan principal will decline in a straight line, right? Then from a charge-off perspective, what you've shared with me is the charge-off rate is 30%. So we can assume that 30% of principal plus interest earned will not be collected, right? It's great. And I think what we need to determine now is what is the potential profit that the client can make, right, if they were to offer financing, right? So let me take a minute, because I think there is a lot of information here, and I think a math could be a bit complicated. So let me take a minute to analyze this and come back to you with my quantitative analysis approach.
Excellent.
Thank you. So Ben, I think let me share my approach to calculate the profit opportunity, right? First, I would like to calculate what is the profit from increased medical billing, right? I think the profit from increased medical billing will be a function of the profit that the client generates through each denture, from each denture, that is, multiplied by the number of incremental patients, multiplied by the number of clinics that he has, right? Now, the profit that the client makes from each denture is $2,500 minus $2,000, because $2,000 it is what it costs them, and they sell the denture for $2,500. So the profit is $500 per denture. The incremental number of patients per office that we computed was 100. So that's $500 into 100 multiplied by the number of clinics that the client has, which is 800, right? So 500 into 100 into 800. So that gives me 50,000 into 800, and that gives me around $40 million, right? So the $40 million is the profit that the client is making from incremental medical billing, right? So that's the first analysis step, right? Next, what I would like to compute is the interest earned, right? Now, this is where I would like to confirm my approach with you, right? Now, the way I would like to calculate interest earned is average loan balance, right? Because the principal is declining every month, right? So if I get the average loan balance, I can multiply it by the monthly interest rate, right? Because you've given me annual interest rate, I can divide it by 12 to get the monthly interest rate. And then I can multiply it by the number of monthly payments, right? So average loan balance multiplied by monthly interest rate multiplied by the number of monthly payments, right? This will give me the interest earned over the lifetime of the loan, right? Does that approach sound reasonable to you, Ben, this quantitative approach?
It does, yes. Please move forward.
Thank you. Now, average loan balance, I will determine that using the principal amount, right? Our principal amount is $2,500. We know it is declining on a straight line. So the average loan balance will be half of the principal amount, right? Which is $2,500 by 2, I get 1,250. This is my average loan balance, right? So the way I'm thinking about it is that if there are 36 monthly payments, the loan balance in the 18th month, right, will be nothing but $2,500 subtracted from $2,500 into 18 by 36. That's how I'm thinking about it, right? So it's half, right? Then monthly interest rate is 20%, the annual interest rate divided by 12, right? That's my monthly interest rate multiplied by the number of monthly payments, which is 36, because the loan is will be paid back over 36 months, right? So 1,250 into 20% by 12. Now 12 threes are 36. So it's 20% of 1,250, which is 250 into 3 gives me $750, right? So $750 is interest earned over the lifetime of a loan per loan, right? So the client will make $750 per loan, right? Next, what I would like to do is that compute what is the potential loss per loan due to default, right? And you have shared with me that 30% of the principal plus interest value will not be collected, right? So 30% of $2,500, which is our principal, plus 750, which is our interest. So that gives us 30% of 3,250, which is $975, right? So what this means is that client is losing $975 per loan, right? Now that's an interesting observation, right? And that could be the reason why existing financing partners of ours are not offering loans to subprime patients, because they would be losing $225 per loan, right? $225 into 100 into 800, because $225 is per loan. We have 100 patients per office and we have 800 clinics. So 225 into 100 into 800, that gives me $18 million. So $40 million minus $18 million gives me $22 million. So overall, right? So if I consider profit from increased medical billing, interest earned over the lifetime of the loan, and then the charge for the loss due to loan default, I get the profit value of $22 million. Does that seem right to you, Ben?
Yeah, it does. And certainly some very interesting insights kind of there throughout in terms of why perhaps some partners may or may not be offering these opportunities with us. So, you know, the math in isolation certainly looks good. A lot of insight to be taken away. But there's worry about the potential impact to the rest of the business. Can you help me come up with some types of categories of risks that launching the captive financing service might eventually raise?
Yeah, I think that's a very very pertinent question, Ben, right? Because from a financial perspective, at least so far, we have seen they could be profitable, but I think there are definitely material risks to consider over here. So let me take a minute to formulate some risks that the client should analyze and mitigate for. Yeah, I could come up with 4 key risks, Ben, right, that the client should consider. The first is credit risk. Now, when we did the profit calculations, we considered a default rate of around 30%. Now, if that default rate were to trend higher, it will severely affect the financial stability of the company, right? Because it could wipe out a lot of their profits, even from the healthcare business, right? So that's an important risk to consider. A second risk to consider over here is a regulatory risk. A healthcare provider entering into consumer lending space, what kind of regulatory scrutiny could that attract? Right? That's a pertinent risk to consider. The third is reputational, right? Again, a healthcare provider entering into lending space, will that be considered predatory by the general public, which will harm the company's image? The fourth is conflict of interest, because we have partnerships with financing partners who offer loans to our patients, right? Will they stop collaborating with us due to competition concerns, right? So these are 4 key risks that I think which are important for the client to analyze and mitigate for.
Excellent. Yeah, and I think 4 risks that certainly should not be ignored as we move forward. A colleague on your team has benchmarked captive finance organizations in other industries and actually believes it will take about $15 million investment to launch the department and add $10 million per year in SG&A. Kind of building off what you've done previously, how long will it take for this investment to potentially pay back?
Great, thanks, Ben. Let me recap the information that you've shared with me. You've shared with me $10 million SG&A expense, all right? And you've also shared with me there will be a $15 million of investment cost or setup cost to set up the captive financing arm, right? So earlier in our calculations, we had got a profit opportunity of $22 million, right? Now we'll need to subtract that from $10 million of additional SG&A expense, which gives us a net profit of $12 million. And when I consider the investment cost of $15 million, what we can derive is that we can recoup the investment cost in a matter of 1.25 years, right? So 15 by 12 gives me 1.25 years. So that's a very short payback period. It's a very attractive payback period for the client to consider. And also, when I look at the $12 million in net profit that the client is making, let me quickly compute what is their total profit today, right? Because you've told me that they have, they are generating $500 for each denture, right? And they have 300 patients today, and they have 800 offices. So 500 into 300 into 800, right? That gives me a figure of 5 3s are 15, 15 8s are it's 120. So it's around $120 million is their total profit, right? So $12 million of additional net profit the client will make as a ratio of $120 million is a 10% increase, right? Which would be a sizable increase, right? So I think barring other material risks which kind of prohibit entering this space, I think from a financial perspective, it does make sense for the client to open a captive financing arm.
Excellent. So, given all the analysis that you've certainly led thus far throughout the case, it'd be great if you could lead the final presentation with the client. We're ready to give kind of our executive summary. Could you help us provide that result?
Sure. So let me take a minute to, formulate my thinking so that I can present a very structured recommendation to the client. Thank you. So Mr. CEO, wonderful to work on this problem with you. The core question of the analyst is, should you establish a financing arm to attract underserved patient segments, right? And if it represents an attractive cash flow stream. Now, based on a purely financial analysis, the recommendation is to go ahead and set up the financing arm. 3 key reasons why I suggest so. 1, it's an attractive profit increase that you would get. The profits will increase by $12 million. It's a 10% profit increase. The payback period is short. The investment is paying back in just 1.25 years. And I think this is also a good way to expand your reach and attract underserved patient segments, right? Because, for example, once you start serving subprime clients, they might buy a denture from you, but they will also opt for other treatments. So you could make revenue, indirect profit from selling other treatments to these patient segments. However, from a next steps perspective, I think it is important to also consider the capabilities, right? So you will need to ensure that you can really operationalize the financing arm, right? So can you acquire capabilities related to loan underwriting? Can you fund these loans? Or can you raise capital to fund these loans? And finally, I think the most important barrier in terms of launching a captive financing arm is to really do a detailed risk analysis and determine, can you mitigate the potential risks, right? Some of the risks that you should look at is credit risk, regulatory risk, reputational risk, and also any conflict of interest risks, right? And if these risks can be managed by you, in that case, we would recommend that you should establish a financing arm because it is offering you an attractive cash flow stream. Thank you.
Excellent, Ashwin. Thank you very much for your time today.
Hey everyone, it's Kenton Kavesti here, the founder of Rocket Blocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocket Blocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocket Blocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.